All right. Good morning, everybody. The first day in a new month, and we're starting off just a little weak, nothing too extreme yet at this point. Just remember, until something fundamental changes, we run with what we've got, not what we think we're going to get. There is an interesting setup. This is what a bullish Haramni looks like. Best when it's found at the bottom of a swing rather than, at the top of a swing. Take a look at what we have on Microsoft here. We had the bullish Haramni, and now we're IX10 inside of that. So the big candle and then being inside of it the next day, inside day of a big candle, not such a big deal. But then when we go inside of that with an inside day and it's a smaller candle, it becomes more of a big deal, get more compression. Compression is what leads to those big moves that we all want to trade. We had one here on Apple a while back where we had that really big doji day and then 2 days inside of it that were really small. And then the big breakout from that. We can look back, and see we had a lot of that same setup in multiple places here on the fangs. We'll get into it, but we've got, a bullish Romney on Tesla. Yeah, it's a list, right? Netflix, classic one. So looking at what's going on around the world today, red on the screen through most of the world. Japan is still in the green, up more than 1.25%. But that's not saying very much. And then for the US, it's kind of flat. We got the Dow 30 less than a quarter, S&P just past a quarter. And our benchmark is 0.5%. So if it hasn't moved at least 0.5%, then we don't really consider it one way or the other. Europe is down the most, about 1%. We've already started to get into the job numbers. Today we have JOLTS. We also have ISM manufacturing, which you can see has the highest anticipated impact. Looking back, historically, how has ISM manufacturing impacted the market? Significantly is what this says. More often than not, the data that comes out of ISM manufacturing is enough to shake and move the markets. So it's something that you want to pay attention to. This is FX Street, and it's useful, especially when you're looking around the world, trying to figure out what you're holding and what your threats are, not just in our markets, but something that could happen, say, in Japan that moves the markets around the world for, the entire quarter. We'll continue with jobs theme tomorrow, looking at ADP employment. And as you can see, it's another one with a really high impact anticipation. It's jobs week. JOLTS is pretty easy to remember if you just think of the old song, "Take this job and shove it," right? The grass is greener somewhere else. In good economic environments where there are plentiful jobs everywhere you look, people are hiring, and you are confident that you could quit today at one spot and have a new job today at a different spot, that's what they're recording. If you're not confident, if the economy is not good, there's not a lot of jobs, you hold on really tight to the one you have because you're kind of worried that you might not find one if you lose it. Like it was back in the 07, 08, that housing crisis in the oil field. If you had a job and you hung on to it with both hands, and all around us, rigs were hitting the dirt. We were watching all of our friends lose their jobs, and you just knew inevitably it was going to happen. There was nowhere to go either. Right? That's JOLTS. Keeping track of the prevalence of jobs out there and how easy it is to leave one to go get another one. Caterpillar had a massive earnings today, just wow. And it's important because different stocks are kind of held as a bellwether. Jamie Dimon, he's no policymaker, right? The guy who runs a bank. And yet when he speaks about the economy and how he thinks things are going to go, people listen, right? Apple, when they report, Google, and believe it or not, Caterpillar, what they say, how they say it, how they're doing as a company is held up as a gauge or a marker on how we're doing as an economy. And their amazing blowout earnings today says that things are just fine. Now, on one hand, that's cool because that's what we all want, right? Good, strong economy where we can all make money. On the bad side of that, for anybody looking for the Fed to cut, why would they ever cut, right? Things are great. They don't need to cut. They can keep raising rates so that they have more ammunition in the future should they ever need to cut if economic conditions start to get bad and they want to, give the market a feel-good pill. They can cut. You can only cut till you get to zero. So, the farther away from zero they can get in good times means they have more ammunition in the future in bad times. So I say keep raising rates, but that's just me. They didn't ask me for my opinion. Can you believe it? How rude. 8:45, 9 o'clock, and that gets us through it. Now, I heard on Bloomberg that this Friday they're going to be talking to that Goolsby guy, and they named off a couple of other people. Be interesting to see, what the outcome of that is, and if it sparks anything through the weekend where they have to come out and run a full Ginsburg. So we'll see. And we do have an additional auction, although it's not really labeled as that, at 11 o'clock. So 9:45, 10, and then 11. After that, you should be good with your 0-day trades. There's really no economic calendar event to be mindful of. Just watch the clock, right? Because there's always economic data coming out. Even if it's not listed here, every hour and every half hour, and on a lot of times, the quarter hour, you're getting new economic data, which is why a lot of times, if you are a flow trader, when we get a new 15-minute candle or a new 30-minute candle, and we just get the flow picks up even just for a couple of seconds, and you see that the pace of the tape increase and volumes are coming in, and then it just kind of fades off again, that was an economic report coming out. It wasn't big enough to really shake the markets, but you were able to see it. There's just so many, right? There is really so many data points, from grain shipments to all kinds of stuff. We are still inside week, giving that 10-week moving average more time to get caught up with us, working on that reset, right? We really need that reset, that kind of hold the fort, call a timeout, let the market heal itself, so to speak. This is what is healthy. It helps us continue this bullish move. We don't want to go parabolic, right? I know it always sounds good, buy the market, watch it run to the moon, but a parabolic market is going to collapse, right? It just can't sustain itself. So it's good to pause, consolidate, even pull back a little bit. Right now, the pullback that we're watching for is Friday's close. That would be last week's weekly candle. Open, high, low, close. They are very dominant concepts, even though, they are simplistic, but simple works, right? It's the most effective pivots that you can come across, and there's no doubt or confusion. I was talking with somebody yesterday about how difficult it can be for people who aren't used to the gray areas of the market, right? They're used to very solid yes, no, clear, lights on, lights off answers to questions. But in the market, a lot of times the answers you get are kind of muddy, or, they're not solid yes or no's. They're, yeah, sure, kind of, maybe. And yet those 4 pivots are, there's no gray area. There's no ambiguity. They are solid, absolutely written in stone and very clear. So there's the maybe the solid answer that you're looking for. Now, when we move all that over to the ES, instead of being on SPY, now we can see this breakdown, right? So the weekly close of last week, 46.07, we're now under that level, and then we have to reclaim it if we're going to continue that bullish break. We're still maintaining with the 10. In fact, we're moving back towards it. That's the 10 week. And right now, 50% of last week is the line in the sand that we really want to keep our eye on. $45.94. And of course, this thing is doing some rounding, so it doesn't come up to a perfect tick. Round number, 45.94. That's 4 points below the weekly pivot point and the ADR half, which we've already reached, right? I know that this has got a lot of stuff here, but we hit the weekly pivot point and we hit the ADR half this morning. That's where the market stopped in that fall. And between 2 and 4 in the morning is where we had the biggest part of this move. That was the kill zone. So right now, if we break that weekly pivot point, we want to focus on the 10-day moving average, which is 45.84. On our way to 45.84, we have 45.94, which is 50% of last week's candle. A bullish market should not go below that 50% mark. If it does go below it, it needs to get back above it by, the end of the week, which, saying it that way, it seems like, well, that's not going to be really helpful. But no, it should struggle significantly to stay above that level if it wants to remain bullish. We can see the volumes are normalized. We're not in overly heavy volume, and it's not too light. It's just about where it needs to be, around 109, 110. That's good. That's normal. The full ADR is 45.78. That is in range, but there's no reason to believe we're going to get that bared up. Right? There's no reason to be that heavily negative under the market. We're slightly bearish. We're still holding above the 10-day just fine. So, that 10-day here is this 10-day here. It doesn't quite match yet, right? Because the market needs to open into regular trading before this ticks over correctly, but either way. So on the daily chart, what we want to focus on is yesterday's low, 45.95. We can see that low with this red line here on the intraday chart. So we got some key levels to focus on if this breakdown is to continue. One, keep track of how far away we are from the VWAP. We can be bullish and still have a down day, right? But it won't get out of control. This will be a very measured sell-off, right? Everything will be, there won't be any real fear or anxiety. It'll just be nice, clean, systematic movement to the downside. Probably won't see volatilities spike too high. We won't get this out of control, runaway train to the downside. So it's very likely going to be measured moves and a nice orderly exit, right? And with that in mind, every one of the pivot points are very likely going to be places where we stop and pause, consolidate before we would leg down to the new zone until it finally just stops going down, right? Because that's really the base case argument, is that we're going to stop going down. This won't be a big, massive sell-off yet. And in fact, yesterday's low is very close to that weekly midpoint that we were just talking about a little bit ago. So rather than focus on yesterday's low, I'd rather focus on that 45.94. We've got a pretty good range set at this point. You can kind of run it wherever you would like. Say we split the midpoint there of that box. There's our zone. And the strat would suggest that each time we come up to a pivot, we're likely to go past it a little bit more, right? Liquidity resides on the other side of the pivot. Maybe you've heard that before. So when we had a pivot here, we broke it, we expanded beyond it just a little bit. We had some pivots here, we broke it, we expanded beyond it a little bit. Had pivots there, did the same thing. That's why we get such a megaphone pattern, right? Until finally it breaks and we make a big move. Well, that big move is kind of what we're looking for. So at this point, we've got our low. We need to see if we're going to break that low and make a lower low. Doesn't have to be extreme. We're not talking about selling off all the way down here. We're just talking about a little deeper low than we had the last time we had the low, right? Just like here, we had a low, we went a little bit lower. Now we've got a low to focus on. We're expecting to go a little lower. At some point, this will break. To the upside would break and we'll target this high back here. To the downside, it'll break and we'll target 50% of this move like a half back play. %50 of that move would be 45.89.5. So we'd want to see a break of 45.96 and then 45.89, get us moving in the right direction. $10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We have a classic D shape. You see the very large volume profile uniformly distributed it into a bell curve standard deviation. Point of control is still below us. If we break the second largest price shelf in here, it's very likely we're going to go down to that point of control. It would become inevitable, right? So really a break below 4,600 offers that point of control, 45.85-ish. It's not much. Certainly it doesn't account for anything like support or resistance or anything of that nature. It's going to be more of an inflection point. We want to see how price responds when and if we get back to that level, and whether or not it'll become a turning point. One thing that is not up for debate, right, is what it can stand for. Well, that point of control represents where the largest amount of volume traded by price, right? So more transactions happened at that price than at any other point on this 10-day chart. That's not my opinion, that's fact. So when it comes to using these kind of tools, there's our analysis of what the tool is trying to tell us, and then there's just the facts of what the tool is giving us. And that's a fact. That's where the greatest amount of volume is at, right? That's where the most transactions happened. It stands to reason that maybe everybody who wanted to trade there didn't get a chance. And B, anybody who did trade there, but the trade so far hasn't worked in their advantage, may use that opportunity to now go ahead and get back out at break even. Whether they went short and they are now having a chance to get out of their short, or they went long and they now have a chance to get out of their long. So when we get there, we want to see, one, how we approach it, and then two, what the order flow is on the dome and how the tape is responding as price comes down into that level, whether or not it's going to be a support or a resistance level. And remember, when we use that phrase support and resistance, the word potential belongs in that sentence, right? Because it's potential support or potential resistance, and it is only support or resistance after the fact. It did support the market. It it was resistance in the market, but until it already happens, it's not support, it's not resistance. That VPOC that we drew the other day is still there. We didn't hit it yesterday or in the Globex this morning. So no, we're not taking it off. We don't have one from yesterday. We still don't have one from Friday. The range that we're in is really showing up nicely here on this screen. We need to get out of this zone, right? So if you're a newer trader and you're struggling, say yesterday was maybe a little rough for you, today isn't going to be any better until we get out of this range. So one thing that you could do is just sit on your hands, not participate until we get out of this range. On the other side of that, I'm crazy super excited for a chance to go long off of these lows and run it back up again. If I go long off of these lows and I get taken out because we break down, okay, I mean, you know, I'm going to catch another one. It's not a big deal. Winning and losing, keeping score of our wins and our losses isn't what we're trying to accomplish, right? That's what we do in sports. It's how much money can we make and how little can we keep our losses. So this is a great opportunity to run it off the lows back up to the highs. And again, if it breaks down and I'm wrong, I'll catch it later, right? Or flip the trade over and go short. We are nearly 3% above the 10-week moving average, but we are continuing that decline off of the high, which makes sense. We're kind of sideways, really not going anywhere, and it's giving that 10 time to catch up, right? So we're continuing that decline. If we think of these as it's a pretty choppy wave, but as a wave, then we're on our way back down into the valley or into the trough. If we look at what the expected move was for the week and the range that we're designed to participate in, everything is just fine. We're basically where we were yesterday. We're in that same zone. We haven't done anything since Friday. On the daily chart, however, things change up a little bit. We are below 50% or a half of a percent. We're getting closer to 1/4%. We had a reset last week where we came down and tagged that 10, and we had another one on the 7th or on the 10th, excuse me. So we've tagged the 10 or we've come really close to the 10 a few times in the last market month. And it looks like we're going to get a chance again. It is worth noting that, you know, kind of like when you throw a basketball up in the air, the first couple of bounces are these big bounces, right? Really slow. But if you don't interfere and you just let the ball continue to bounce, as the bounces up get less and less, the frequency of the bounces becomes greater. You start getting more and more bounces, more and more small bounces, right? Well, think of it like that too. With this, when we were getting these big sweeping bounces off the 10, and it was getting these really nice highs off of it, they were still lower highs than we had in March, lower highs in June than we had, or in July than we had in June. So they're getting less and less and less. And we want to start looking at the frequency of the breakdowns, because at some point we're going to get a larger reset, right? If you weren't trading before COVID, we used to have a sell the rip and a buy the dip policy, mostly a buy the dip policy back then, right? We'd wait for a good 5 to 7% pullback, and we would just recycle everything that we had already gotten out of for new longs again and make these massive first 5 to 7 point recoveries and then advancements above that into a new zone. Then you'd have to get out, recycle, wait for them to, you know, chop around, pull back down a good 5 to 7% again, do it over and over and over and over. Buy the dip mode is back, right? It's back in full force. So today things are not looking quite as rosy as yesterday. Remember all the green we had when we came in yesterday. Bitcoin broke 29,000. That's a really important key level. Now the day isn't done and the week isn't done, but 29K was the line in the sand, right? We needed to hold that line, and now we've broke it. So while the candle isn't confirmed yet because the week isn't over yet, it's a start in the direction of that breakdown that we're looking for. You want to really keep your eye on the Bitcoin proxies now. Mara, Riot, Coin, and see how they're doing. And then of course, you know, we have that trend spider list that kind of keeps track of all those Bitcoin proxies that we got from the Smalls exchange in their crypto product. And that had things like NVIDIA, AMD, PayPal, all of those were connected to that whole space. I got too many on here. I've got to close some or it's going to give us errors. So let me knock these out to blanks. And we'll just keep the ETF build. So here's my own little homemade ETF on things like Bitcoin, the EV space, pot stocks. This has Riot, Mara, Coin, Hut, and Hive. And we can see they're down, you know, a little bit this morning, modestly, still inside yesterday's range. Nothing too extreme yet at this point. Looking at it on the daily, we had a nice 20 tag, but we haven't followed through yet. And it's a very wide TRB setup. So if we are looking for a play here, it's got to get out of this red candle, which is now IX10. We've got to get out of this zone, which also lines up with a TRB, right? That'll be a 10-period moving average crossover with a breakout above this big red candle. And the target is at the very least back to that 160, maybe through all of these sellers that are sitting up here between 160 and 165. They are certainly not gone, right? When we come back up in there, there's still a large amount of sellers there. We just don't know how many yet. We need to see it on the tape. So that's the Bitcoin proxies down the most out of everything that we're going to look at. The China ADRs also down this morning, JDD, PDD, Neo, Baba, Baidu, that kind of group, right? And with those, kind of the same thing. We're still inside day, little weak, still holding on, still haven't broke down completely. Looking at it on the daily, we had a nice advance. All the moving averages are fanned out nicely, but we still don't have a 5,200 cross. And on the weekly, I mean, that was a key breakout. But now it's got to keep it. And any of these sellers from back here, we got to really look at that and say that they've been taken out. Right now, they're taken out doesn't necessarily imply that they're gone. They could have got smart and said, why sell here? If it looks this bullish, I'll just wait and sell it up here. So, you know, we still need to see the tape, but otherwise that wick and the whole, you know, rally based drop concept with liquidity right there, nah, we've taken that off the table. Got a nice 10-20 cross, which is crazy bullish in the bigger picture. That's a weekly chart, 10-20 cross. We're still underneath the 200, so you know it's not a picture of health, but those China ADRs, there's still a lot of power in there. That's not done yet. So it's a little weak this morning, but big picture, that 10-21 is going to hold a lot of weight. It should have some pretty decent follow through. All right, these are steel names. So X Steel, Newmont, things like that. It's not looking that good. I think I got maybe an ETF in here that doesn't have a good pre-market measure. So, I have to kind of hunt around and see which one of these names I might need to eliminate to get. I think I found it, maybe. We'll come back to it. The EVs. Also weak, breaking down a little bit. This is Lee, Neo, Nikola, Rivian, Tesla, XPEV. Airlines, also weak. So the one that's leading the most are the Bitcoin proxies. And behind that, the China ADRs, which kind of makes sense because it's been this massive short covering rally with a dash for trash, right? And that big whole squeeze thing going on. So if that is the newest thing, those people that, what do they say? Last in, first out. So, it kind of makes sense. A little bit of weakness. Everybody's jumping ship. But behind those two, the EV space, which is still a lot of China ADRs, and then the airlines with travel behind that. So then that gets us into pot stocks, which had a pretty good run, right, over the last week or so. 1021 still very far apart. This is not a picture of health in any way, shape, or form. At some point, someday, we're going to turn around and begin moving back up, kind of like nat gas, but it ain't happened yet. All we've had is that little pop to the upside. And this morning, it's not as weak as the others, right? All things considered, it's down a little bit, but not by very much. So that space might be, fare a little better this morning. Financials, they closed on the lows compared to a lot of these others that closed at their highs. So nice little rally up this morning. It's showing that they're down because we had that spike going into the close, and now they've faded down below that a little bit. But really, I'd say they're basically where we left off. There's some cybersecurity stuff. I haven't really cleaned that up too much. And then some refiners. With these FANG names, the monsters of tech. That is not the monsters of tech. What do we got here? Oh, that's communications names. Yeah, like, wait, what do we got? So communication's been kind of blowing up. You can see it here when we go out to the weekly chart, right? 2023, it's been one heck of a year so far. This is, Google, Meta, Netflix, Disney, all those kind of wrapped in there together. So big gap down this morning. It hasn't even started to try to recover yet. For the FANG names, that looks really, really similar to communications at this point this morning. So everything's weak or negative, not much looking good or positive yet. We need things to turn around. We need to get out of that zone. We could see the FANG names yesterday just really didn't do anything. And the financials closed, like I had mentioned, in the lower part of the day, right? They stayed under VWAP all day, and then right at the end had that little push back up, made it through VWAP. You look at the advancing versus the declining issues yesterday, we made it into distribution by the end of the day. Sure, we popped back up going into the close, but for the S&P, I mean, it was just working its way down. The interesting thing is, if we zoom out a little bit, over a 2-day period, right, from Friday and then into Monday, it's been just a continuous decline, worse and worse and worse, right? And if we were to go out and start running analysis on the bigger picture, how many stocks are, closing in accumulation versus distribution? How many stocks are above their 50, their 200, their 20, those kind of old school market breadth tools still provide a lot of insight into the bigger picture. For the NASDAQ, it's a completely different picture. Friday still maintained this really strong posture, and then Monday was where all the weakness was, and we just stayed in it all day with no real change. We had a classic signal yesterday with that green line crossover, and then it stalled, nothing happened. But that really got my attention. It just didn't get any follow through to it, and so I never did post it anywhere or talk about it. But that's the kind of breakdown that we're looking for. But again, it stalled. Like it never got the follow through that we would have expected it to get. So hopefully I've been able to kind of impress upon you that we have to get out of this box, right? For everything. If you're going to trade tech or banks or airlines or whatever it is that you want to trade, we got to get out of this range. 80% of the market will do whatever the indexes are doing. So if the indexes are kind of stalled and weak and flat, then 80% of the market's going to be stalled and weak and flat. It's interesting to note how different SPY looks from, say, IWM. See how IWM moved yesterday? This kind of a classic flag shape. So, flagpole, and then there's the flag itself with a continuation in the after hours. And sure, it's sold off a little bit now, but that looks completely different, right? Going all the way back to Thursday at the end of the day, closing near the lows with a run up into Friday, and then a continued run up into Monday, and into Monday night, into the overnight, into Tuesday. Look at that really amazing move. And then go back to SPY. Not so amazing, right? So the Russell is small cap stocks. You can get into things like IWM, but then there's like IWV, things like that. You can change how small of a small cap you want to look at. So this is a ratio chart, IWF and IWD. It's often considered to be a momentum chart, depending on how you want to look at it. This is not something that I come up with. It's been around for, I'd say a good 40 to 50 years. You really don't want to get into a smaller time frame than a 1 day. But you can see how everything really did change at the first of the year. We went from that continuous downward grind, kind of flipped everything over, and we've been marching back to the upside ever since. Now we stalled out, and then we had a little fake breakout fast failure. Well, we don't have the failure yet, right? All we had was the breakout and then back down again. So this needs to resolve itself. We're trying to break out again. And if we do, then we're going to just continue that march upwards. Otherwise, it's very likely that if we retest that 116, 117 area and we break it, then we're going to actually start setting some lows that we haven't had for a while yet. So far, it's all been higher highs and higher lows. So let's get out of this range and then we'll see. The Qs ain't waiting. So we've already started that breakdown here in the NASDAQ. We've got an inside day breakout to the downside with new lows on the day. $379, call it 380 to the downside right now. And if we wanted to measure that range that we've had, $381 is the next target in our push to the downside. All right, so we do have a channel. It's the typical NASDAQ channel. Down at the 40s, we'd have to get there. And then, of course, the quarterly levels on the way there. No voodoo lines to deal with since we just broke a major one at 15,793. For the ES, it was that 4602. That thing had been a brick wall, right, or a concrete floor. We finally got through it, but we've been here, right? We were there yesterday multiple times. We've been to this same location. So we really need that breakdown. And until we get it, we got to assume we're just going to flip around and come right back up. If we do get that breakdown, though, 50% of the measured move gets us to 45.89. Call it 45.90. We can see the Dixie continuing that push this morning, getting a little parabolic, and US dollar Japan with a nice little breakout. We are through the weekly level, and then next stop 143.5. So dollar rising, US dollar Japan rising, 10-year rising. We can see that same move here. Remember, it's not just the fact that it's going up, it's how fast is it going up. Big, sweeping, fast moves, no good for the S&P, right? No good for the NASDAQ. So as long as these three are still continuing to point upwards like a rocket ship and moving in a straight line up, you got to look at the S&P and the NASDAQ in weakness, not necessarily an immediate short, right? You don't want to just slap the table and go in with both feet to the downside. But it does imply that any bullish moves are going to be hitting a lot of resistance, right? Flow resistance, maybe not a line in the sand kind of a resistance. Headwinds is another word for it, right? We need tailwinds, not headwinds. So these are going to be a weight around the market's neck and albatross, right? We need to turn that around, get it off of there. So these need to quit moving up, whether it's because they hit a resistance point overhead or the flows change. Remember that at 8:15 and 8:20, the dollar opens, the bonds open. And so we could start to see a dynamic shift. But at this point, the only thing we're seeing is a continuous push and a drive to the upside, which is going to take the S&P and the NASDAQ down. Cool, cool. Yeah, you like it. And with those going down, everything else is going to go down, right? And if anything doesn't, and it stands out, right? Because obviously you can have the one that bucks the trend and does its own thing. So out of all of these, if everything else is going down and you find the random one or two that isn't and is continuing to go up, then, you know, pounce on it with both feet, because that's what the market's going to do. Everybody, be careful. Have a good day. And I will